Bull call spreads. A bull call spread is made up of two call options. You buy a call with one strike price and write or sell another call with the same underlying stock, the same expiration month, but a higher strike price. A bull call is a debit spread because the long call always costs more than the cash you receive for the short call. You always pay a net debit to establish it. Here's an example. A. Buy one XYZ June 50 call at $5. Sell one XYZ June 55 call at $3. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.